Have you ever done this? You pull up the stock price for a company you really like, maybe, I don't know, Amazon or Tesla.
Oh, yeah. Or even Berkshire Hathaway, right? The numbers are just wild.
Exactly. And you see that price for just one share, and you just get that feeling of, nope, not for me.
Mm-hmm. That instant investing is too expensive thought.
Yeah, like the price of that single share is more than, maybe your whole checking account balance right now.
Yeah.
Definitely more than you're comfortable risking.
Yeah, it's a completely natural reaction. That's sticker shock.
Yeah.
A $500 share, $1,000, let alone, Berkshire's crazy numbers. It makes investing feel like this exclusive club.
With a huge membership fee you can't afford. You just think, how could I possibly get started, let alone, build a portfolio with different companies?
Exactly. And that barrier, that high cost of entry, it's historically been very, very real for a lot of people. But what if there's been a shift?
A shift?
Yeah, kind of a quiet revolution, actually, in how everyday people can access the stock market. A way you can get a genuine slice of that investing pie. Even if you only have, say, $5 or $10 or maybe $20 to put in.
Wait, seriously? Like with that little?
Seriously. And that shift is all thanks to something called fractional shares.
Fractional shares. Okay, I've heard that term.
And you guessed it, that's exactly what we're doing a deep dive into today.
All right.
So our mission here is to really unpack what these things are, not just the definition, but how do they actually work behind the curtain,
Yeah, the mechanics.
Exactly. And probably most importantly, weigh up the pros and cons, the real advantages and the potential, maybe hidden disadvantages. Specifically for you, if you're a beginner or maybe investing smaller amounts.
Right, for the people who felt locked out before.
Precisely. We've gone through a ton of material for this, financial articles, research papers, even online discussions in investing communities.
So real-world perspectives too?
Yeah, trying to get a really clear, complete picture. We want to cut through the noise, and give you the essential info you need to understand this way of investing. It's getting really popular.
Okay, great. Let's dive in. So unpacking the concept. What exactly are fractional shares? It still sounds a bit fuzzy.
Yeah, it can, but the core idea is actually pretty simple. It's the how that gets interesting.
Okay.
So fractional shares are, they're exactly what the name suggests. They're portions, subdivisions maybe, of a full share of stock or an ETF share.
So pieces. Little pieces.
Little pieces. The key thing is you don't have to buy the whole thing anymore. You're not forced to buy one entire single share. You can just buy a part of it.
Right. Okay. So give me an example. Like if a stock cost $150 a share, normally I'd need $150.
Correct. For one whole share.
But with fractional shares, I can maybe put in $15 and get what, like a tenth of that share?
Precisely. That's the core of it. You got it. Various sources like Voya and Bookmap, they really emphasize this. Think about a big tech stock. Maybe it's trading at $1,000 a share, which is, a lot.
Yeah, definitely.
Well, with fractional investing, you could potentially buy just 0.001 shares for $1.
$1 for a piece of $1,000 stock.
Yep. NerdWallet uses a similar example, like investing $10 in a stock that costs $100 a share. You'd own exactly 1/10 0.1 shares. It just completely changes the accessibility equation for expensive stocks.
It really does. Okay, so how does that happen? Like, are the companies, Apple, Google, whoever, are they suddenly issuing stock in these tiny little bits? That doesn't sound right.
You're right. That's not how it works on the company side. They're still issuing whole shares like they always have. The magic, so to speak, happens entirely at the brokerage level.
Ah, the platform where you buy and sell.
Exactly. Bookmap explains this pretty well. The brokerage firm, they go out and buy full shares on the open market, standard practice.
Yeah.
But then internally, inside their own computer systems, they divide those full shares up into smaller pieces.
Digitally slicing them up.
Kind of, yeah. So when you go to place an order, and importantly, you often place it as a dollar amount, like, I want to buy $25 worth of Apple.
Right, not I want to buy 0.17 shares.
Exactly. Your $25 order gets pooled with maybe thousands of other small orders from other investors wanting fractions of Apple. The broker then buys the necessary number of full shares to cover all those fractional orders.
Okay.
And then allocates the correct fraction of ownership back to each investor based on how much money they put in.
Okay. So the broker is the middleman doing all the complex slicing and dicing and keeping track of who owns exactly 0.05 shares versus 0.12 shares.
That's exactly it. They handle the pooling of the money, buying the full shares, and then all the internal bookkeeping for the fractions. And this is really important, something lots of sources like Pocket Option, Bookmap, Forbes, Funding Souk all stress.
What's that?
When you own that fraction, you do own part of the underlying asset. It's not just like a tracker or something.
So I actually own a piece of Apple.
You own a piece of Apple, and that means you're entitled to proportional benefits based on the size of your fraction.
Proportional benefits, like if Apple pays a dividend.
Exactly like dividends. If the company pays out, say, $1 per share dividend, and you own half a share,
I get 50 cents.
you get 50 cents. If you own a tenth of a share, you get 10 cents. Now, Funding Souk does make a fair point that for really tiny fractions, the cash amount might seem, well, tiny.
Yeah, a few pennies, maybe.
Could be. But the principle is sound, you get your proportional share of the benefits.
That makes sense. So before this became common, was it just impossible for small investors? Always had to buy a full share?
Pretty much, yeah.
Yeah.
For individual investors buying directly through a broker, NerdWallet and Bookmap point this out, you needed the cash for at least one full share.
Wow.
So this whole fractional share thing, enabled by technology and these brokerage platforms, it really has changed the game. It's democratized access in a pretty big way.
Lowered that huge barrier.
Absolutely. Though it's worth a quick side note, Forbes mentions that fractional shares can sometimes pop up in other ways too.
Oh, like how?
Things like stock splits, where
Yep.
one share becomes 2 or 3. Or dividend reinvestment plans, DRPs, where your dividends automatically buy more stock, often resulting in fractions, or even sometimes through mergers. So you might end up with fractions without deliberately buying them in dollar amounts.
Interesting. But the main way people get them now is buying those dollar amounts through their broker.
That's the main focus, definitely.
Okay, so we get the concept. Owning pieces, brokers handle it. Now let's get to the really crucial part for, someone listening who's thinking about starting. Why is this such a big deal? What are the killer advantages, especially for beginners or people without tons of cash?
Well, the number one advantage, the one everyone talks about, the absolute core benefit, is accessibility.
Accessibility, accessibility, accessibility sounds like the key takeaway.
It really is. You look at Voya, NerdWallet, Funding Souk, Bookmap, Forbes, they all hammer this home. You genuinely do not need a lot of money to begin investing anymore.
How little are we talking?
Many platforms have minimums like $1, $5, $10.
Seriously, $1.
Yep. It just completely removes that massive financial hurdle that used to keep so many people out. People who felt like, oh, investing's only for rich people.
Yeah, that feeling is real.
This lets you literally just dip your toes in the water. Try it out without committing, hundreds or thousands of dollars you might not have or might be scared to risk.
That's incredibly powerful. If you're just starting your career, or maybe you're on a really tight budget, needing $500 for one stock feels impossible. But finding $10 or $20, that feels doable.
Exactly. It makes investing practical, not just aspirational.
Turns it from this distant, scary thing into something you can actually do.
Right. And that accessibility leads directly into the next massive benefit, which is diversification.
Ah, diversification. The old don't put all your eggs in one basket rule.
Yeah.
But how do you do that if you could only afford one basket or maybe one egg?
That's exactly the problem fractional shares solve. Traditionally, with whole shares, if you only had, say, $300 to invest, you might only be able to afford one share of a $250 stock, or maybe 2 shares if they're both around $150.
Right. So all your money is tied up in just 1 or 2 companies.
Exactly. That's called concentration risk. If one of those companies hits a rough patch, your entire investment takes a hit.
Ouch.
But now, with fractional shares, using that same $300, you're not limited by the $150 or $250 share price anymore.
So what can I do with the $300?
You could decide, okay, I'm going to put $20 into 15 different companies, spread it out across tech, healthcare, consumer goods, finance, whatever sectors you choose.
So instead of one whole share of company A, I can own a little piece of A plus a piece of B, C, D, E, all the way to 15.
Precisely. You can buy fractions of each. You instantly build a much more balanced portfolio, spreading that $300 across many different companies, maybe even different industries or ETFs. Pocket Option even suggests aiming for maybe 15, 20 stocks across different sectors for decent diversification. Fractional shares make hitting that kind of target way faster and cheaper for small investors.
So it manages your risk better because if one stock tanks, it doesn't pull your whole portfolio down with it.
Exactly. It's a huge practical advantage. Takes diversification from being just a theory you read about to something you can actually do with limited funds right from the start.
Okay, that's compelling. What's another big pro?
They are absolutely perfect for something called dollar cost averaging, DCA.
Right, DCA, that's where you invest a fixed amount of money regularly, like every month, no matter what the market's doing, right?
You got it. And NerdWallet and Bookmap really emphasize how well fractional shares work with this strategy.
How so?
Well, think about doing DCA with whole shares. Let's say you commit to investing $100 every month in stock X.
Okay.
What happens if next month stock X's price jumps up to $110? Your $100 isn't enough to buy a full share anymore.
Uh-oh, so I have to wait. Or skip a month.
Exactly. You either have to save up more, breaking your 100-month rule, or you skip the investment. It messes up the consistency, which is a whole point of DCA.
Right.
But with fractional shares, that problem just disappears. You invest your set, $100 or $50 or $25, whatever your amount is.
And the broker just buys $100 worth.
Exactly $100 worth. Whether that buys 0.9 shares or 1.1 shares or fractions across multiple stocks, if that's your plan. You always invest your target dollar amount.
So you can stick religiously to your plan no matter the share price.
Precisely. And that consistency is key for DCA. You automatically buy more shares when the price is low and fewer shares when the price is high.
Right, averaging out your cost over time.
Exactly. It helps reduce the risk of bad timing, like putting all your money in right before a dip.
Yeah.
Fractional shares make this disciplined approach really seamless.
Takes the guesswork and emotion out of it. Just steady accumulation.
Spot on. And like we touched on at the beginning, it gives you access to those really high-priced stocks.
Yeah, the ones that felt completely out of reach before.
Being able to own a piece of those companies you admire, the ones you think have massive growth potential, it's a big deal.
Like getting a slice of Amazon or Tesla, or even thinking about Berkshire Hathaway.
Exactly. Voya, Funding Souk, Bookmap, Forbes, they all highlight this. It lets small investors participate in the potential upside of these major companies, regardless of their budget. It really does level the playing field for which companies you can invest in.
That feels really significant. It's not just that you can invest, but what you can invest in.
Yeah.
Companies you actually believe in.
Absolutely. And one last point, maybe a bit softer, but still important. Fractional shares help build the habit of investing and your confidence.
How does buying tiny pieces do that?
Well, Voya and Bookmap touch on this. Because the entry cost is so low and it works so well with regular small investments like DCA, it encourages consistency.
Makes it part of your routine.
Yeah, it turns investing from this big, scary, maybe once-a-year thing into a regular practice, like putting aside $20 every payday. And as you do that, you see your account, you track the value. Even if it's small at first, maybe you get a tiny dividend, you start to feel more comfortable. You gain experience.
Takes the fear away.
It can, yeah. It builds familiarity, reduces that anxiety. Investing stops feeling like this exclusive club activity and becomes something you actively do. And that process, it builds confidence, maybe encourages you to learn more, explore other things down the line.
So it's like financial empowerment through actually doing it, even on a small scale.
Exactly. It's a powerful aspect for beginners.
Okay, that's a really strong case for the upside. Accessibility, diversification, DCA, big company access, building habits. But, nothing's perfect. What's the other side of the coin? What are the potential downsides, the risks, the things people need to watch out for?
Oh, there are definitely things to be aware of. And some are pretty significant depending on what you want to achieve. One that comes up often is about shareholder rights.
Ah, right. You mentioned maybe not getting to vote.
Exactly. Sources like Funding Souk, Bookmap, Forbes, and even Reddit discussions point this out. Holding fractional shares usually means you don't get the full rights that come with a whole share.
Primarily voting rights.
Yeah, that's the main one. Voting on company matters, like electing the board or approving big corporate decisions. You typically don't get a direct vote with fractions.
Can the broker vote for you?
Some platforms might sort of bundle up all the fractional votes and vote the block, but it's not guaranteed and you don't have individual control. Basically, you get the economic exposure, but not necessarily the governance say.
Okay. Piece of the profit, not piece of the power.
That's a decent way to think about it. But maybe a bigger practical issue for many investors is liquidity, and especially transferability.
Liquidity. How easy it is to sell. Is that a problem?
Usually not for selling within a major platform during market hours. For common stocks, the bigger problem, highlighted by Funding Souk, Pocket Options, FAQs, Reddit threads, Forbes, it's transferring your fractional shares between brokers.
You mean if I use broker A now, but I want to switch to broker B later. I can't just move my fractional shares over.
Generally, no. Not the fractions themselves. Most brokers will let you transfer your whole shares, no problem. But the fractional pieces, they often require you to sell them first. Liquidate them.
Whoa, okay. So I'd have to sell my little slice of Amazon, turn it into cash, then move the cash and maybe rebuy it at the new broker.
Exactly. And that can be a real pain.
Why is that?
Well, first, selling triggers a taxable event if you've made a profit. You might owe capital gains tax.
Tax implications.
Second, it forces you to sell at that specific moment's market price, which might not be when you wanted to sell. Maybe the price is down or you just wanted to hold long term. It takes away your control over timing.
Adds friction and potential costs just to switch brokers.
Yeah.
That seems like a big downside compared to whole shares.
It's definitely a significant practical consideration, especially if you think you might want to consolidate accounts or switch platforms down the road.
Okay, good to know. What about fees? We hear commission-free all the time now. Are fractional shares really free?
This is super important, especially for beginners starting small. Pocket Option and Forbes dig into this. Well, yeah, many platforms advertise $0 commission for stock trades. That doesn't mean there are no costs.
Hidden fees.
Not always hidden, but definitely other costs. Pocket Option mentions things like the bid-ask spread, the small difference between the buying and selling price, which is an implicit cost.
Right, the market maker's cut.
Yeah. There can also be currency conversion fees if you buy international stocks fractionally. Some platforms might have inactivity fees if you don't trade often enough, or fees to withdraw your money.
So commission-free isn't necessarily cost-free.
Definitely not. And here's the crucial part for small investments.
Yeah.
Those fees, even if small in dollar terms, can be a huge percentage of a tiny investment.
Explain that.
Okay, let's say you invest $10. And maybe there's a spread or another small fee that amounts to, say, 50 cents. That 50 cents is 5% of your $10 investment. Gone, right off the top, before your investment even has a chance to grow. Now, if you invested $10,000, that same 50-cent fee is negligible, right? Almost 0%.
Wow, that percentage impact is massive on small amounts.
It's critical to understand. Pocket Option really stresses calculating that percentage impact. Those small costs can seriously eat into your returns if you're making lots of tiny trades.
Which leads to another potential issue you mentioned, over-trading.
Exactly. Pocket Option highlights this danger because it feels so easy and cheap to buy just $5 or $10 of a stock.
The temptation is there to do it all the time.
Yeah, some people might get drawn into trading constantly, trying to jump in and out, catch tiny price swings, basically day trading with tiny amounts.
And that's usually a bad idea.
Research suggests, yeah. Pocket Options data indicates frequent trading often leads to worse returns overall, partly because of those accumulated fees eating away at profits, and partly because timing the market consistently is just really, really hard.
So easy access is great for long-term DCA, but dangerous if it encourages gambling.
Well put. Ease of access needs discipline, not impulsivity.
Okay. Now, you mentioned something earlier about what you actually own. Sounded a bit complex.
Yes, this is a really important nuance raised by BlackRock, a huge asset manager. It gets into the weeds a bit, but it matters.
Okay, lay it on me. Isn't a fraction of a share just a fraction of a share?
You'd think so, but it depends on how the broker sets it up internally. BlackRock draws a key distinction. Are you getting direct beneficial ownership of a fraction of the underlying stock or ETF?
Okay, sounds like what we discussed before. Owning a piece.
Right. Or are you potentially buying something slightly different, maybe a derivative contract where the broker promises to pay you based on the stock's performance?
Whoa, a derivative. That sounds different, less secure.
It can be viewed that way. BlackRock argues that with a derivative model, you're not technically a direct owner of the stock. You're more like a creditor to the broker or whoever issued that contract.
A creditor. Like I lent them money and they owe me based on the stock.
Sort of. And that introduces counterparty risk. What if the issuer of that derivative, the broker, maybe runs into financial trouble? Your claim might be different than if you directly owned a piece of the actual stock.
Yikes. That sounds like a pretty big difference.
It is. BlackRock really pushes for clarity here. They want platforms to be upfront about which model they use so you know exactly what you're buying. They support regulations making this clear, avoiding confusion where derivatives might be marketed as if they were direct fractional shares.
Wow. Okay, so as an investor, I need to try and figure out how my broker handles this. Direct ownership or derivative contract?
Ideally, yes. It adds a layer of due diligence when choosing a platform. Look at their customer agreements, their disclosures. Direct beneficial ownership is generally seen as the more robust model from the investor's perspective.
Okay, that's a subtle but potentially critical point. And speaking of broker risks, what about if the broker just goes bankrupt? We talked about transfers being hard, but what if the whole firm fails? Are my fractional shares safe?
Yeah, that's a valid concern that pops up sometimes in places like Reddit discussions, because fractional shares are held in the broker's street name, often in a pooled account.
Not directly in my name, like a paper certificate used to be.
Right. And the argument some people make is that this pooled ownership makes fractions riskier in a bankruptcy.
So if broker X goes under, is my little piece of Google gone?
Well, it's generally considered more nuanced than that. There are regulatory protections in place. In the U.S., you have bodies like FINARA overseeing brokers and investor protection schemes like SIPC insurance.
SIPC.
I can see it.
They insure your brokerage account, right? Up to a limit.
Exactly. SIPC protection aims to help investors get their securities and cash back if their brokerage firm fails, up to certain limits. This protection applies to assets held by the broker, including those in pooled accounts. BlackRock also mentions how brokers manage custody of client assets.
So there are safeguards.
There are safeguards designed to protect you. The goal is that your securities fractions included would be transferred to another firm, or you'd be compensated if they can't be recovered. However,
there's a however.
The complexity of untangling who owns precisely which fraction within a failed broker's giant pooled account could, potentially, make the recovery process slower or more complicated compared to recovering easily identifiable whole shares.
So maybe not lost forever, but potentially more hassle in a worst-case scenario.
That's probably a fair summary. It's an added layer of complexity rather than a guaranteed loss, but it's a difference compared to holding whole shares directly registered. Something to be aware of.
Okay, helpful distinction. Any other downsides?
Just one minor one, mentioned by Funding SAC, those potentially underwhelming dividends we talked about.
Oh, yeah. Getting pennies back.
Exactly. While it's proportionally correct, if you own 0.01 shares, getting maybe a cent or two in dividends might not feel very exciting or impactful, even though it is still a return.
Especially if you're picturing getting a nice slice of the pie and you just get crumbs.
Understandably so, though many brokers let you automatically reinvest those tiny dividends to buy even tinier fractions more, which helps compound things over time.
Okay, so, wow, we've covered a lot. The huge pros. Accessibility, diversification for everyone, making DCA easy, getting into those big name stocks, building good habits, and the cons to watch for. Limited rights, the transferability headache, fees eating into small amounts, the risk of overtrading, understanding what you own, direct versus derivative, the broker solvency nuance, and tiny dividends. That's a lot for a beginner to process.
It is.
So how do we boil this down? What's the practical, actionable advice for someone listening who's thinking, okay, maybe fractional shares are for me?
All right, number one, absolutely critical, echoed by Voya, Pocket Option, everyone really, is research.
And not just researching fractional shares themselves,
Right.
Researching the actual investments.
Exactly. Just because you can now buy $10 of company X doesn't automatically mean you should. Do your homework on the underlying stock or ETF.
Like, what does the company actually do? Is it financially healthy? What's happening in its industry?
Yes. Understand the business, the fundamentals, the competition. Don't just buy something because it's famous or because you can finally afford a tiny piece. Use good sources. Make informed decisions. Sound investing principles still apply, even if the dollar amount is small.
Don't throw caution to the wind just because it's only $10.
Precisely. Second big piece of advice. Choose your broker wisely.
Right. We know there are lots of options now. Fidelity, Schwab with their stock slices, Robinhood, JP Morgan M1, Public. What should people compare?
NerdWallet, Pocket Option, Bookmap, Forbes, all give pointers here. You need to compare them on several things.
Like what?
Fees are huge. Look beyond just the headline commission. What are the spreads like? Are there fees for transfers, inactivity, currency conversion? Dig into the fee schedule.
Hey, fees first.
Also, account minimums. The range of investments offered fractionally, some brokers only offer them on certain stocks or ETFs, like maybe just the S&P 500. How easy is the platform to use? And crucially, try to find out their policy on how they handle fractional ownership, direct beneficial ownership, or derivative, and what are their rules for transferring assets out.
So really read the fine print on the broker's website or agreement.
Absolutely. Understand their model and rules before you put your money in. Third, and this is just basic personal finance 101, Prioritize your overall financial health first, meaning pay off high-interest debt, especially credit cards, and build up a solid emergency fund.
The safety nets.
Yes. Voya really stresses this. Before you start investing even small amounts with fractional shares, make sure you've dealt with expensive debt and have that cushion, maybe 3-6 months of living expenses, set aside for unexpected emergencies. Investing always involves risk. Don't invest money you might need suddenly or money that's costing you 20% interest on a credit card.
Get your financial house in order first. Solid advice.
Definitely. Fourth, have some awareness of the regulatory environment.
Like knowing Finishu oversees brokers in the U.S.
Yeah, and that brokers offering fractional shares have rules to follow regarding reporting, best execution for trades, and providing adequate disclosure about their policies. It's not the Wild West.
Okay.
And regulators are paying attention as this grows. Forbes mentioned discussions in the UK about allowing fractions in tax-advantaged accounts, showing the landscape is evolving. So while protections exist, understanding your broker's compliance and how they safeguard your assets is still wise.
Good to know there's oversight.
And finally, tying back to the overtrading point, focus on a long-term strategy.
Use fractional shares for the right reasons.
Exactly. Pocket Option and Bookmap emphasize this. Fractional shares are fantastic tools for consistent long-term investing habits like DCA, building wealth slowly and steadily. They are generally not suited for frequent short-term trading, trying to time market swings. Have a plan, know why you're investing in something, and stick to it.
Okay, great summary. So bringing this all together, the big picture is fractional shares are genuinely revolutionary for access. They tear down that cost barrier, let beginners and small investors actually start, diversify properly, and invest in top companies.
Absolutely. They open the door.
But you absolutely need to go in with your eyes open. Be aware of the limitations, no voting rights, the real hassle of transferring fractions between brokers, the potential impact of fees on small amounts, the danger of overtrading.
And that crucial difference between direct ownership and derivatives, plus the nuances around broker solvency.
Right. And always, always do your homework on the investment and on the platform you choose.
That's the balanced view, yeah.
So if you're listening and feeling ready, maybe the next step isn't necessarily to jump in feet first, but to start that research phase.
That sounds like a smart approach. Maybe research a couple of companies you're actually interested in, or compare a few of the brokerage platforms that offer fractional shares. Look at their features, their fees, read their customer agreements, understand what they offer before committing.
Empower yourself with information first.
Exactly.
Okay, and before we wrap up, here's something to chew on. Building on what Bookmap mentioned about market events.
Oh.
How is this seemingly small thing buying pieces instead of whole shares, not just changing things for individual investors, but maybe reshaping the entire stock market?
Reshaping the market, how do you mean?
Well, think about it. Traditionally, big stock price moves were often driven by huge institutions, right? Hedge funds, pension funds, buying massive blocks of shares.
Sure, the big players.
But now you have potentially millions of small investors all over the world who can suddenly buy $5 or $10 worth of that same stock all at the same time because of fractional shares.
Ah, so their collective action adds up.
Could it? Bookmap pointed to examples like GameStop or Tesla, where a huge amount of the trading volume and the intense price action seemed to be fueled, at least in part, by a massive number of individual investors acting together, enabled by easy access platforms and potentially fractional buying power.
So the collective power of the small investor amplified because they can now actually participate fractionally in any stock.
Exactly. Giving millions of small investors the ability to buy fractions might give them a collective market impact on trading volume, maybe even price volatility that just wasn't possible when they were priced out of buying even one share.
That's actually a really interesting thought. What does that mean for the future? For market dynamics, price discovery, maybe even how companies have to think about their shareholder base if it includes millions of tiny owners.
Right. It's a potentially huge ongoing shift, all built on these seemingly simple slices of the investing pie. Definitely something to think about as you consider starting your own journey.